Listen, if you clicked this thinking it's just another silver update, you're already behind. Because what happened isn't a normal up day, it's a warning. Silver didn't just climb, it snapped. In a few hours, price punched through levels that used to feel impossible. While on the other side of the planet, the physical market did something even louder. Buyers in Asia started paying a brutal premium for real silver. Not contracts, not promises, physical metal, and that's the real story. Not maybe one day, not in the long run. Right now, physical pricing is threatening to drag the paper price upward like an anchor being ripped off the ocean floor. If you've been waiting for the moment where both markets stop pretending they're the same thing, you might be watching it unfold in real time. So in this video, we're breaking down exactly what happened, and why it happened, and what it could mean if you're holding silver, watching gold, or wondering if mining stocks are about to wake up and go completely insane. And yes, we're also going to talk about the weirdest threat to your silver that might already be sitting inside your own home. It's funny until it's not. Stay with me. Quick action. Subscribe right now for fast updates, and in the comments type, John A.G. Best. So I know the real community is here. And if you're here, hit subscribe now because the next move won't wait for anyone. Now let's go to the part where the stress is highest, because the market always tells the truth where the pain is. Overnight, the story wasn't silver is up. The real story was Shanghai's physical price surging and the gap versus the so-called US spot price widening into the kind of premium that should not survive in a normal market. Think about what that means. Buyers weren't negotiating. They weren't waiting for a pullback. They weren't saying, let me see what happens. They were bidding for metal right now, and they were willing to pay a massive markup to get it. And when that happens, it's not a chart pattern. It's not a vibe. It's stress. Because if the paper market truly represented real supply and demand, a premium like this would close fast. Arbitrage would attack it, metal would flow, and prices would equalize. That's what textbooks tell you. But we're not living in a textbook world anymore. We're in a world where the East is aggressively buying physical, while the West has leaned on price through paper for so long that the physical market is starting to behave like it's in a completely different universe. Two prices, two realities. One system trying to pretend they're the same thing. And once you see that, the entire story starts to make sense. Now zoom out for a second, because emotions can ruin you faster than a bad investment ever will. Silver is hovering around the $90 area. And yes, it sounds insane to even say that out loud. But here's the part that should rewire your brain. Not too long ago, silver was sitting under $30. That's not hype. That's not exaggeration. That's real. And moves like that trigger big emotions. Big emotions make smart people do dumb things. So here's one of the most valuable lines you'll hear today. Don't let emotions drive decisions. Not now, not ever. Silver doesn't move politely. It's not a gentle trend. It's a rocket with turbulence. And I want you to answer this in the comments because it tells me exactly where your head is at. Do you think silver pauses at $100? Or does it blast straight through $100 and shock the world? Drop your answer below. Now here's the crazy part. Silver can be moving like this and most people still won't even notice. A major holder recently said something simple but brutal. Silver can explode and only a tiny fraction of people will understand what's happening. And that's true. You can walk into a room of 100 people, and maybe one has ever seriously thought about the monetary system. Maybe one has asked what happens when debt piles up and trust starts cracking. Maybe one understands why hard assets have survived every currency experiment in history. That's why this market can gap higher when attention finally hits. Because when the public arrives, they don't arrive early, they arrive late. And late money doesn't arrive calm, it arrives desperate. Now let's talk about the real driver behind this move. Physical decoupling. For years, people have warned we could hit a moment where the price on a screen stops behaving like the price you pay to actually get metal in your hands. And what we're watching right now looks like the early stages of that exact event. Because when you see huge premiums in major physical hubs, it's screaming one thing. The metal is not where it's supposed to be. And the supply chain can't instantly fix it. And that's when paper promises start looking fragile. Now here's where it gets even crazier. The Western paper market trades silver in volumes that don't even feel real. On a recent trading day, hundreds of millions of ounces traded on paper in one day. Think about that. The paper market can churn an amount of silver that rivals an entire year of global mining output, and we're supposed to call that normal price discovery? Come on. This is why silver often feels like it's being held down. It's why it can drop violently for no reason and then crawl back up like nothing happened. A paper market that huge can create the illusion of supply even when physical supply is tight. It can create fake calm even when real inventories are under pressure. And the moment physical forces paper to reconcile with reality, you get moves like this, Right in the middle of all of it, there was a quiet signal most people will ignore, but it matters. Certain official coin products were paused while pricing was being evaluated. Translation: the input cost is moving so fast and demand is so hot they don't want to sell something that becomes outdated before the paperwork is even printed. That's not a conspiracy. That's operational stress. And stress changes markets. It's also why the price action starts looking weird. Not smooth rallies, but jagged moves. Sharp dips, quick recoveries. That's a blade action where it feels like the market is getting hit with a hammer and then pulled right back up. That's a tug of war. Paper liquidity pushing down. Physical scarcity pulling up. So if you've noticed ugly intraday action lately, don't ignore it. That's what pressure looks like. The system is trying to balance two realities at once. And it can't do it smoothly forever. Now let's talk about the part that makes rallies turn into rockets. Shorts getting trapped. There was a moment where a major desk positioned against silver was forced to cover when price ripped through key levels. You don't need the name. You just need the lesson. When you short something, you borrow a promise. And if price moves against you fast enough, your broker doesn't care about your opinion. Your broker cares about risk. So they force you to close the position, which means buying into strength. Forced buying in a tight market turns a rally into a vertical move. That's why people call it face ripping. Because the market doesn't just beat you. It humiliates you. Now stack another layer on top of that. The narrative is changing. For years, precious metals were treated like a relic, like a hobby, like something weird people do when they don't understand modern finance. But lately, bigger institutions have started floating ideas that were unthinkable not long ago. Meaningful allocations to precious metals as part of modern portfolios, not 1%, not 2%. Real allocations that actually matter. And in a market as small as silver, even a small shift in allocation can create massive consequences. That's the scale problem. Big money barely needs to move to cause a massive repricing. Now let's sharpen this point because it's the core distortion. When massive amounts trade on paper in a day, that's not metal, that's receipts. Receipts work only when everyone trusts the warehouse can deliver. The moment the market suspects receipts exceed inventory, the game changes. That's when you hear polite phrases like delivery stress, cash settlement, backwardation. But all of them mean the same thing. There isn't enough metal to satisfy demand at the old price. Now I'm not saying the system collapses tomorrow. I'm saying fragility increases the longer it leans on paper. And fragility creates outsized moves. Here's another angle most people miss. When the physical side is tight, the market doesn't always respond with a nice, smooth trend higher. Sometimes it responds with sudden gaps and violent whipsaws because participants are hedging in panic. A manufacturer needs metal and doesn't care about a perfect entry. A fund is short and suddenly cares about survival. A dealer sees inventory shrinking and widens spreads. Those are not signals on a chart. Those are human reactions to pressure. And when humans react like that, the chart just becomes the scoreboard. The real game is happening in warehouses, in delivery lines, and in decisions made under pressure. Now, what do you actually do with this information? First, if you hold physical silver, know where it is, how it's stored, and who has access. I'm serious. People get excited, they stack, they celebrate. And then the plan stays blurry. Decide now if your stack is a family asset, a personal hedge, or tied to a future goal. Because once prices get crazier, nothing creates sudden interest like a headline and a number on a screen. And let me add something practical here. If you're holding metal at home, don't treat security like an afterthought. Think like a professional. Not paranoid, just prepared. A small safe in an obvious place is not a plan. A hiding spot that everybody knows about is not a plan. Even a basic checklist can change everything. Who knows? Who doesn't? What happens if you travel? What happens if an emergency forces you to move quickly? These are boring questions until the day they become the most important questions of your entire stack. Boring today, priceless tomorrow. Second, if you're thinking about mining stocks, don't treat them like silver. They're not silver. They're businesses. Management teams, costs, political risk, dilution risk, financing risk, all real. So if you want that leverage play, stay disciplined. Third, if you're just watching and learning, don't let the speed of the move make you feel hopeless. Markets don't move in one candle forever. They breathe. They shake people out. They create opportunities at different moments. Your job is education, not emotional chasing. Now here's the next cliffhanger. And this is the question that decides whether this becomes a sprint or a long-term repricing. What happens when retail shows up? Because right now, demand is largely institutional, regional, and informed. Retail demand is different. Retail demand is messy. Retail demand is emotional. Retail demand is FOMO. And when FOMO hits limited inventory, you don't get calm price action. You get discontinuities. You get gaps. You get out of stock signs. So watch availability as much as you watch price. If you start hearing consistent reports of empty shelves, longer delays, shrinking selection, That's the market shifting from pricing to rationing. And rationing is where things get dramatic. Here's the part nobody wants to say out loud. Rationing doesn't feel like a normal bull market. It feels like chaos. Dealers stop quoting tight prices. Premiums jump overnight. The product you wanted yesterday disappears today. And if you think, I'll just wait a week, you might come back to a completely different reality. Not because the world ended, but because inventories are thinner than people realize, and demand arrives in waves. That's what makes this market dangerous and exciting at the same time. Now let's talk about gold for a second, because silver is explosive, but gold is the foundation underneath everything. When gold reprices, the gold to silver ratio becomes the battlefield. If the ratio compresses, silver can run harder. If it stays wide, gold leads. Either way, the metals complex stays hot. That matters for miners, for hedgers, and for anyone trying to protect purchasing power. And I want you to answer this in the comments too, because it reveals strategy. If the gold to silver ratio drops hard, would you swap some silver into gold or ride silver all the way? Tell me below. Now, we have to address the miners, because this is where people get confused. They look at silver near $90 and they look at certain mining stocks and say, why aren't these already flying? Here's the truth. Miners are leveraged plays. When the commodity price rises, profits can expand faster than the price itself, assuming costs don't rise at the same speed. Simple example. If a miner produces silver at $20 and sells it at $30, margin is $10. If costs stay around $20 and silver sells at $60, margin becomes $40. Price doubled, margin quadrupled. That's why miners can go from ignored to adored fast. But they often lag until the market sees proof through earnings and cash flow. Once that proof hits the reports, attention gets forced, capital flows. The miners can move like they're strapped to a rocket. But don't forget, not every miner wins. Some are mismanaged, some are diluted to death, some operate in dangerous jurisdictions. So don't be lazy, do your homework. And there's another twist. Even when silver is ripping, some miners won't move at first because big funds rotate slowly. They need confirmation. They need liquidity. They need narratives they can sell to committees. But the moment those big players decide the trade is real, they can buy in size. That's when you get those crazy days where a miner gaps up 15%, 20%, 30%, and people act surprised. That surprise is the sound of capital finally waking up. Now zoom back out, because this move isn't happening in a vacuum. There are bigger forces behind all of this, and they don't care about your opinion. Liquidity expansion is still happening globally. Debt is massive. Supply chains are being politicized, and geopolitical instability keeps rising. In that world, hard assets stop being alternative, they become necessary. And once institutions start thinking that way, the runway gets long. Now let's take a breath. Because we've been intense. Time for that threat in your home part. There's a meme in the metals community that says, when silver was cheap, your spouse thought you were insane. Then when silver rises, it becomes our stack. And when it goes parabolic, it becomes my stack. So yes, joking aside, your biggest threat might not be a bank. It might not be a hedge fund. It might be the person upstairs who suddenly discovers a deep emotional attachment to your shiny rounds. Laugh now, plan now, because if you don't decide rules early, chaos decides rules late. Now here's the final trap you need to understand. When silver runs from under $30 to near $90, the brain starts doing two dangerous things. One, it assumes it must crash because nothing goes up forever. Two, it dreams of infinite upside because look what it just did. Both extremes will hurt you. The healthier mindset is simple. Understand your thesis, understand your time frame, and understand your plan. If you don't have a plan, the market will write one for you, and you won't like it. So here's the clean summary. Physical premiums are screaming urgency. Paper volume shows structural distortion. Institutional attention is growing. Mining leverage is building. Macro forces like liquidity, debt, and instability are pushing long-term tailwinds. This isn't seasonal, it's structural. So instead of obsessing over a magical number like $100, watch the forces that are driving the move. Now I want to add one more retention point because people always ask, how do I know when the real mania is here? I watch the behavior of people who never cared before. When you see random headlines everywhere, when your friend who mocked metals starts texting you questions, when searches spike, when dealers can't keep products on shelves, that's the moment the trade changes. That's when patience turns into panic. And that's when the upside can get violent, but so can the pullbacks. That's why the smartest move is to stay calm, stay informed, and let your plan do the talking when the crowd loses its mind. And now I want to leave you with a challenge. If you got value from this breakdown, hit like, subscribe, and comment, John A.G. Best, so I know you're part of the real crew. Final question. From here, are you expecting a controlled climb or a violent breakout that shocks the market? Drop your answer below. Because if physical premiums stay elevated and paper keeps pretending nothing's wrong, pressure keeps building. And pressure doesn't stay pressure forever. It resolves, either through a pullback that shakes out weak hands or through a surge that forces the entire world to reprice silver in real time. So stay sharp, stay disciplined. And remember, the market doesn't reward the loudest people. It rewards the prepared ones.